Good morning, Julie. Thanks for being with us on the M&A Diaries. Been looking forward to this conversation. We're going to get into the depths of how to make your practice attractive to acquirers and also preparing for sale, which, as we know, is super important, both for the seller's benefit, but also the acquirer's benefit as well. But before we get into that, it'd be great if you could just give us a little bit more context around yourself for our listeners, and obviously Wilkinson's as well.
Oh, sorry. Do I sound all right? Just 1 second.
Yeah,
Sorry.
sound absolutely fine.
Okay, cool. Hi, I'm Julie Wilkinson. I'm the owner and founder of Wilkinson Accounting Solutions. My background, I'm a chartered management accountant by trade. I worked in corporate for 20 years, started life in purchase ledger and worked my way up. Pretty much worked in every finance team you can work in corporate, so over a couple of different companies. And then I started my practice off the back of the work I did in my last corporate job, because I ended up running a project which was over 3 entities, and it actually involved an SME entity that had been acquired. That was the first time I'd have ever actually worked in a smaller business. I'd always worked for the group. And I went into that company, and one of my roles was to put the controls, all the infrastructure in place. And what I realised was, even though it was actually a part of this group, it was sort of ran like a family-run business. And to be honest, it was ran pretty poorly in terms of the financial setup. So I went to market and I did a survey, and I asked 20 businesses from about 50,000 turnover to 20 million what their accountants did, and 100% only saw their accounts once a year. So I realised there was a gap in the market
100%.
for sort of more strategic finance support, not just over time. I don't just mean day rate CFOs. I actually mean infrastructure in terms of how is your business set up. And that is where we specialise now. So we specialise in mergers and acquisitions. So we help people with exit planning to put in a financial and governance and controls infrastructure, so they can transition their business to an asset, meaning the owner can strategically move their way out. So they maximise their own generational wealth through their business, and also to help people grow by acquisition, because that's a way they can spearhead their growth to ultimately get the assets that they desire in their business.
Lovely. Thank you, Julie. Appreciate that context. And obviously all of that is going to be really great. We talk about the accountancy practice industry here today. As we know, there's lots of activity going on in the market at the moment, and it seems to have only increased this year. And I feel that the dynamics at play are being highlighted even more by some of the conversations that we're having. So to kick off the conversation, it would be great, as an acquirer in the accountancy practice industry yourself, what are the key things or important matters that you look at when you're first evaluating an acquisition opportunity?
Yeah, so I have acquired another accounting practice. I think for me, what I'm finding in the market is a lot of the sellers going to market are sort of below the £1 million mark, and they are still quite heavily owner operated. So I would be saying to people that an accounting practice is no different to any other business being sold. I mean, ultimately, every buyer is typically looking to buy an asset, not a job. And that is one of the things I've found in accounting practices is owners are quite heavily involved. So when I'm looking at businesses, I'm looking at who is their customer profile, how owner operator are they, and ultimately how does that impact their net margins, because often in accounting businesses the owners are still sort of paying themselves through dividends like all other owners are, and actually I tend to find the ones I've evaluated, they're not really tracking those in terms of their margins, what their actual profits would be if they were paying that through a P&L, even in the accounting firms themselves, and finding that. So ones I've evaluated above £1 million are run a bit more strategically than they are, but typically the ones under £1 million aren't, even ones are sort of 500, 750,000 aren't running it like that. So I evaluate it the same way I would evaluate any industry, is what margins are they making with the owners and without them. And then I'm looking at, well, if we did have somebody to run those clients, do they actually make any money on those clients, or do they make a good enough margin? And because that would then impact sort of what I'd offer in terms of how many times revenue I'd offer, but also not just that, the earn out that the owner would have to work in, and also the deferral period that I'd pay it back over.
Mm-hmm. So that's you've kind of driven into the financial element, but also, as you said, where the relationships are held, which is often at that sub 1 million, as you quite rightly say, with the actual proprietor of the business themselves. From a people and team perspective, obviously, as we know, we're in a people business, the accountancy practice industry, so it's probably one of the most key elements as well in terms of that post-transaction success. How do you get a feel for the people and the culture alignment prior to an acquisition when you're evaluating the opportunity?
Yeah, I think it is hard. I think culture and people is the hardest really
Mhm.
because you can have job roles and be told what people do, but in the end, you don't really know how well those people are performing and if the owner's actually coming in fixing a lot of problems, because it's not always so much that the owner's lying. Like sometimes I think you just do things naturally without really realizing what you're doing, and that sometimes will come out after acquisition. So I think for me, it's the owner being open to where they are before the deal closes, from the experience of the acquisition that I've done and also other ones I've evaluated, because uh, it's it's not just about, so when we did our acquisition, we did an asset sale and we didn't actually bring over the owners. So we acquired 100 clients. We didn't bring over the owners, and we've retained 95% of them, and we've completely transitioned how they worked because we sort of did a retiring accounting practice. So I think it's all down to as well the realization of the seller of where they are and what are they willing to do before the acquisition takes place, because a lot of owners will come to market and go, well, I want this, I want to keep my staff, I want to keep my premises, I want to keep this. But the truth is they don't make any money on that profile, or they don't make enough money to have someone third party actually want to buy them. So this is where sometimes I have offered more consult for equity sort of situations where we would actually look at their business model and transition it before we did the acquisition on an equity basis to buy, to put in, because if you do an asset sale, you get the legal obligations of the transfer of 2P of the employee. So you're kind of stuck for like 18 months and nobody wants that. But
Mhm.
also on the shares, you've got the same problem because you still have the cost of sort of the redundancies and not that your aim is to make people redundant, but in the end, if the processes aren't efficient and they don't make money on the client, something has to change. Either the prices have to go up, or you have to change the operations, of
Yep.
how who's doing what. And I think sometimes people live in this bubble. They want to protect their staff, they want to protect their clients. But if they've kind of built a business model that isn't making a very good margin on those clients and that team setup, then a third party coming to buy it will obviously want to change that.
Yeah, absolutely, and that's a really interesting approach, and actually one that you don't really see. Most people are in transaction, and they have to handle those problems, potential problems, post transaction. So what you're saying is that you tend to work with the vendor ahead of time to get it almost aligned with the way you work before making the transaction happen.
Yeah, well, that's an option if they want to. Not
Yes. Yep.
everybody wants to do that.
No, of course.
And the truth is, some of them, I've evaluated a lot, and we've walked away from a lot of deals. Then I don't know where those deals will go,
Hmm.
because some people just don't want to, because they're like, oh no, the deal is you have to take my staff. Well, if in the end, if people make margin on their customers with their staff, I've got no real problem taking them. But the starting point has to be you have to be making a good enough margin, including the owner's time. Because if the owner's spending a lot of time dealing with the customers themselves and sign off the return and send it, then what does the new buyer do? They'd have to take on that role.
Yeah, absolutely. I just want to stick with that option that you kind of the approach you take as well, because it is so abnormal or unusual, and I think there'll be a lot of our listeners that would probably try to understand that. So I guess there's two things I just wanted to ask you. First of all, how how do those conversations go when you kind of set out that option to the individuals that are looking to sell? Because I imagine there must be a huge element of trust of working with you prior to an acquisition actually taking place. But then secondly, what the benefit of that is to the vendor eventually when you do transact, if they're allowed to work with you beforehand.
Yeah, so I mean, bearing in mind, I've only had my business fully doing this for the last sort of 2 to 3 years. So
Mhm.
the conversations are relatively new. I've spoken to, so the options are. So I've done it a few times, and obviously I'm reviewing what the opportunities are for people as I go along. So I take each deal really on its own merits based on where
You
they
you have
are.
you have to,
I
yeah.
suppose the benefit is, well, in the end, the benefit to the seller is the reality is they're probably unlikely to ever sell, or if they do, they'll get a really low value, or they'll if they don't get it set up, because either bigger accountancy firms will come in and just more dictate the terms, and they'll have a long earn out, or they won't get much for their business anyway, or they'll knock it off. Or, I don't know where some of these businesses go, but I just think they probably sit on the market. I mean, some of them I've spoke to been on the market for 3 to 5 years, but then they still won't change their mindset of, well, I want to do things differently. Well, then the truth is they'll probably either have to just fold and they won't sell it, or they'll get less money for it. So I think
A
the
lot of the time
benefit,
it'll be a lower multiple. It'll
it'll
probably
be a
be a
low
lower multiple. Yeah.
multiple, long earnouts, and probably, a lot of longer deferrals and things like that. Which, so I suppose the benefit of the consult for equity option is, in the end, it'll get them a higher multiple, because they'll be making more profits. Because I do think when you're valuing on sales, because obviously usually the account practices are on turnover, aren't they? Which is an interesting metric, because it's okay doing it on revenue, but what's the point in buying the revenue if the revenue makes no margin? So although we do value it on turnover, I do also look at it from a multiple of EBITDA, because 1 times revenue, let's just say you're at 500,000 turnover, but you're only making a 10% margin, so a 50,000 margin. If you want 500,000 for it, you're only making 50,000 margin.
Yes.
Accountants can do the maths. That's a lot of years. So how does the buyer pay that back? Actually, make that viable to pay back without that business going under. So they say they want to protect their customers and their staff, but the truth is, if someone's offering this and the multiples don't stack up in terms of actually paying it back, the likelihood is the business could fold anyway, and the staff and the customers could not get the good service that they want. So I think the benefit of the
Yep.
consult for equity is, we would, what I offer is I do more consultancy with the owner to effectively look at the business model and get them to put things in place that could help them. Now, that could be some difficult conversations, because it could be like, for example, in my practice, we've got, we do have an offshore team as well that help us, not just in the UK, and it's more cost effective, and we use AI in certain parts, not to
Yep.
replace people completely, but we do. But that's how, because most accountancy firms should be able to trade at around a 35% margin, and obviously those margins could skew. So, like, for example, last year we might skew when we've got more costs going through because of an acquisition, which are like one-off costs, and that's fine, you can keep track of that. But ultimately,
Yep.
if you're not trading at the 35% margin, but that has to be a 35% margin with all the staff to run the business, including the owner. Not, I'm at a 30% margin, but then you've got to add £100,000 a year in, then that drops that to 15% margin, because then you're not at the 35, and that's a lot of work for someone to move it from a 15% to a 35%. And the 2 biggest changes are generally operations in terms of what staff do in the business and how they're managed, and also and then pricing with the customers in terms of what's their pricing scale. Because when you get to the crux of it, a lot of the account, I haven't really uplifted my prices for 3 years, or the project scoped and we haven't tracked it, and that's all happening because they don't have data, they don't have time tracking, they don't have management reports, they don't have customer profitability reports. But then when the deal closes and that person's now not the owner and they're kind of being measured, how do they track it? That person needs time to be able to build all those reports to deliver to us what they perform. But if they're already working 60 hours a week delivering for the customers, how do they ever do that? So that's the basis, is the business model has to change to make it worth more. So I'd be aiming to help that person get to, the 30 to 35% margin with all the costs.
Yes.
But obviously I have to be choosy as well of who I work with, whether I actually think someone can get there, because it does require not a personality change, but it requires a change in terms of the mechanism. It is a fundamental change in mechanism of how they're
And mindset.
working
Yeah, and mindset.
and
So,
mindset.
so and for them, and I guess the protection for you, because you're consulting, so you're spending time with them. What's the protection for yourself in that type of option, that the consult to equity, and also for the selling party, in terms of you might be dealing with clients at some point, or there's a conversations that are going on there. So how's their protection for yourself, from your time and effort that you put in? Because the deal, if you can't shift to where they need to be, where does that end up? Is it a case of, actually, it's not going to be a deal for us now, or at least the devil that you're dealing with now, so that when you do make the acquisition, it's more of a conversation around, it's going to be a slightly lower multiple, but at least I've got a really good understanding now of your business and where I can make the changes or influence the change.
Yeah, I think, well, how I would usually structure it if I was going to do a consult for equity is obviously my time would be paid as a consultant, and we would have
Got
that
you.
discussion around what that might look like in terms of timeframes. And then my viewpoint is I get first rights to buy effectively.
Hmm.
Um, Now, I suppose relationships can change and mindsets can change as they go, and it can be full buy or it can be part buy because it could be access to my partners or access to some of the ways of working, cross sharing. There's different opportunities of how you can work together to actually scale the business. Maybe the owner wants to keep part shares in the company, but they just don't want. They're struggling to like grow it to where they want it to be, so they want to take knowledge of somebody else and utilize resources effectively. So there are different options, but really it'd be a paid consultant at first on the
Right.
basis of a negotiation and discussion of when the first rights to buy would come, and key points across that time frame. And I suppose the reality is how long that would take, because I've done an acquisition. I actually own my acquisition this year and I've had it 2 years. And I just know from the acquisition I did, which was a retiring practice, it
Mhm.
did take me 18 months to really turn that around fully.
Okay.
It
Okay.
took 18 months, and we're still building now, but we're at more of a point where um, we've got capacity to take on new clients now. So we've got the vision of how we keep the 35% margin with all of the, the key personnel in it. So it can be a bit of a long journey if someone's actually wanting to do it. And I suppose that would have to be a discussion point about how quick somebody wants out versus the value they want to get for the business, basically.
Absolutely. That's a really interesting point, and I think for the listeners at home, just have that better understanding, which is why I was kind of digging in there a little bit more, so they can understand that as a potential option as well. So we've spoken about what you as an acquirer would be looking at any potential acquisition opportunity. So from a seller's perspective, from the vendor's perspective, obviously there's that little bit of the consulting you kind of alluded to a few bits there, but how can they best prepare and be sale ready when going to market to hit or check the boxes of the bits and pieces you were talking about there in terms of client relationships being ported over to maybe the wider team rather than the individual, financials being in place as they should be, codifying processes, making sure you're not signing into long-term leases to make yourself as flexible as possible, those kind of things. So what from a seller's point of view should they be doing on the lead up to entering into sales discussions?
Yeah, so I think for me, what people should do is looking at sort of three key principles. So their own job, like what is their job in the business? Taking some time to actually reflect. Do their staff perform? Like just being honest with themselves. Is their staff performing? You know, are they? If they've got a job role, that's fine. But when they're looking at their margins, is their job role accounting for in the profit and loss? And are they actually doing more than one job? Because that's the first thing. Because I don't think the accounting industry is any different to any other industry.
No.
Is what are their margins? Are their margins reported commercially for the role that they're doing? So I think that's important. So I don't know, but a lot of accounting firms I speak to, they don't even have job specs really
Hmm.
for themselves. They have it sometimes, but they don't have objectives of what those staff are performing towards. So if I do consult for equity, they're the sort of things that I help people look at. Is some of going back to basics on some of the things. Is if you take the, I suppose, the relationship, the emotion out of it, and just look at it in roles rather than people. Like, what's the roles, and are those roles being fulfilled? And if they're not, and there's gaps in those roles, okay, that's fine. Where is the gap in the margins, and how do they fulfill it? So that, I think that's one thing, is just looking at the roles and who's managing it and their profits in line with those commercial roles. That's one thing. The second thing would just be then reporting, because obviously when they go through the deals, you always want to update your management accounts. So if they can't produce management accounts in terms of their sales, what in the sales of what they've done, their work in progress, their cash, then the buyer has sort of a lack of confidence in terms of how well they're managing. And I tell you, well, for me personally, it would make me, I'd be in an accounting firm, the first thing I'd be thinking, especially as I've had my own experience in buying a firm, is if they can't even do it for themselves and they're meant to be helping their clients with these things, what mess are their clients in? Because
Yep.
nobody wants to take, a book of clients of 300 clients and they're all done last minute. then they've got no processes in. So it does kind of, for me, it does kind of show what they're doing for themselves is what they would be perhaps doing for their
Yeah.
clients. Now, some people say, well, it's because we always do it for our clients and I don't do it for ourselves. But what I've seen from the ones I've viewed, actually, often they're not doing it for the clients fully. Now, that's
Oh,
fine because that's an upsell
Julie,
opportunity
nine
for
times out of
us.
10, we see that as well. Nine
Yeah,
times
they're
out of
not
10,
doing
that they
it.
haven't got their own internal financial reporting.
So financial reporting, so job roles and margins in terms of who's doing it, reporting. So basically, at least key reporting in terms of profit by customer, sales by customer, time per employee, that type of thing. The key KPI reports. And then I think the third thing would then be business structure in terms of how is technology, especially these days, like how is the technology impacting, and are they kind of forward thinking like that, because it does impact the multiple. Because in the end, what it actually generally means is if they haven't done any technological advances, they're generally overstaffed because they
Yes.
have to be, because lots of, especially retiring accountants, older, the older owners that maybe might be looking to get rid in the next 5 years sort of thing. What I see is they're still typing out bank statements.
Hmm.
Now
Hmm.
that's not value to a client anymore, really, and people are it is becoming apparent to customers, to businesses, that with AI coming in, they can replace those sort of tasks. Which means the truth is, if those owners don't sell and they didn't turn it around, they could be at risk of losing those customers anyway in 5 years, on the basis that, that they don't want to, that they would go elsewhere, or think whether they can use AI to replicate them is what people are starting to think. And it's not just AI, because I'm not saying it replaces people fully, but obviously systemization and AI is playing a big part to the industry as a whole.
Yeah, I mean, there's certain processes that we know that can now be replaced by AI or some form of technology, and we've started to see that shift now, where the accountancy practice industry as a whole is moving more to that advisory business advisor type style, rather than the computations of accountants from previous. And you're right, at that lower end of the market, sub 1 million, where there are the older generation that are approaching retirement or in their autumn years of their career. A sweeping statement, I know, but most of them probably haven't gone on that technological journey yet as fully as others that are intending to be in the profession for many years to come. So, from some of the opportunities that probably come across your desk and you've had conversations with, I imagine a lot of them are still quite far behind in that technology. They've still got rooms full of paper files still that haven't been scanned on. So that's all things that they really need to be thinking about before selling, to make themselves as attractive as possible.
Yeah, and or they might not want to do that, and
Yes.
that's why they want to sell. And there's nothing wrong with that, but then you've just got to be realistic that you are going to get a lower multiple and a longer deferral. Because I've learned from my acquisition, all the ones targets that I am uh, more firm in terms of like the expectation of the owner and the multiple, probably than I was on my first one. Because obviously you learn every time you go along, and I've seen a lot of things in the industry, and ultimately that's what they're going to have to expect if they don't want to go on the journey. Um, they've got to realise that the person buying it is going to have to go on that journey. Um,
Yes.
and the thing is, when you have the certain things, when you set it up, they're quite easy to bolt on. Like, with the structure I've got, I can scale people relatively easily. um but I think where the buyer has the restriction is obviously the setup, and the certain things that take time to do, so premises for one, and
Mhm.
people, and also customers mindset. Those three things aren't quick to change, and they're all the things that can hinder the operation. So because we might have dual running costs, or things like that when you're buying it, because you're having to streamline and put things in place. So that's just what people have to be mindful of, is they don't want to go through that journey, that's fine, but then they are going to get a lower multiple for it.
Yeah, absolutely. And I had this conversation a lot with people who are potentially selling, that they realise their business is probably not in that shape that an acquirer would look for. But as you said, the more important thing at that point is that your mindset is that you don't mind going on that journey because you know it needs to happen. So rather than being a hindrance when you move in. And why are you changing that, Julie? and especially retiring partners that may be hanging around for that deferred consideration period, they can be a problem if they're not ready to go on that journey and adapt and take on the changes that you're looking to do as an acquirer.
Yeah, and I don't know. I mean, when I did my acquisition, it was very the sellers. It was very much they went round to the owners. Their clients had cups of teas. Um, there was a lot of reservation whether clients would want to go over to systems like Zero or QuickBooks or whatever it is. Sage, whatever it is. Um, but actually, we found that when we did it, people took to it really well. And I think we've systemized over 75% now of all of the accounts because
Fantastic.
people
Yeah.
actually wanted to go, so the value. And I think, there's some real basic things that people aren't thinking about, like just even like, how they track new customers. A lot of them don't have CRM tools. They're not tracking new customers. So when you say things like, well, how do you get new customers? Oh, it's just referrals. But actually, do they get a lot of referrals? Like, do they replace customers very often, or have they just transacted with the same customers for a lot of number of years? And how old are those customers? Are their customers going to be retiring? Because if you're looking at this scenario, said, the 500,000 with the 50,000 margin, if they're expecting a buyer to pay 500,000, and how many years that take to buy back at their margins, will those customers even be around at
Yes. Yeah.
those times to pay it back? Will they actually reap any rewards off those customers at the end?
hmm It is interesting, especially on that valuation piece you were saying there, because obviously historically, especially sub 1 million, it's always been on a GRF multiple or multiple revenue, and we are starting to see that shift a lot more now in that sub 1 million market, where people are looking to value businesses like they would in any other sector and looking at that EBITDA multiple, the profitability of the business. So even at the sub 1 million now, I'm urging people to make sure that their profitability is where it needs to be. Because of that very fact. So, ever more so, the acquirers are looking at EBITDA and maybe basing the valuation on EBITDA multiple as opposed to GRF now. Although, it still is the general rule of thumb is a revenue multiple. But as you quite rightly say, when you're evaluating what kind of valuation you're going to apply to an opportunity, part of that computation is looking at that bottom line probability in the first place.
Yeah.
Yeah, and you're right. Most firms that we deal with, they're probably 35% is where I'd expect to see most practices sit at that 30 to 35%. But at the sub 1 million level, again, just where maybe there is older partners that have just had a way of working and it's suited them, and it's more of a lifestyle type business. We do see a lot in that 10 to 20-ish kind of market in terms of their net profit margin sitting there. But it's, for them, it's earned them a good living. They've been ticking along over the many years, and they're not really thinking about the long-term future because they know they are eventually going to sell. So, as you said, having the opportunity to that consult to equity is quite interesting, because you can go in there for 12 to 18 months and say, well, look, you've been running your practice like this. I can work with you, and it could be the difference between a 1 times multiple and a 0.75 or a 0.7 multiple,
Mhm.
which can be significant sum.
Yeah, definitely. And it could even get higher, couldn't it? Over a
Yes.
period of time. 'Cause if a business is run really well, um, you know, I've seen accounting practices go for 3, 4 times multiple when they're, when they are actually above 1 million, where they are run well, because people want them, because they're going to generate good money quickly.
Yep.
So you can get higher multiples. It's just what the work someone wants to put in to get there, basically.
Yeah, no, absolutely. I was referring to obviously revenue multiples then, but you're right. I mean, above 1 million, the general rule of thumb now is 3 to 5 times, and then as you start getting closer to 3, 4, 5 million, then we are seeing a little peak in valuations at this point in time, and that's mainly because the private equity in the market, they're all fishing in the same pond, and it's simple supply and demand has just slightly pushed the multiples up at this point in time. But outside of just pure financial gain by preparing right. The attractiveness to an acquirer on the opportunity. If there's one firm that is, let's phrase it as prehistoric, there's lots of paperwork still. They probably haven't moved the time, technological wires, and most of the relationships are still sitting with the partner. Compared to a practice same size, maybe a lot more further along in terms of adopting technology, and the relationships are maybe passed to some of the team a little bit more. they might stay out of the same margins, but actually, if as an acquirer, if you're looking at both, you know you've got to go for the one that's going to be easier to integrate, easier to take on, and have less hurdles to jump in the first place.
Yeah, but I think the truth is, James, they can't have the same margins. It's not they might on
Yes, yeah,
paper have the same margins, but the truth be told, they can't, because the difference is how snowed under the owner is, and that can't be shown on paper. So there is no way that it just can't happen. You can't have one business that's operating where the owner's working 60 hours a week, um, who are effectively probably doing 3 part-time jobs, is what you'd argue, to a company that's fully run. Because if they're the same percentage on paper, the one where the owner's doing the 60 hours a week isn't reporting the right number on paper, because it's not possible. You can't, because how can someone that's got all the staff needed to run it and still have a 35% margin be the same percentage as the one that doesn't have the staff on paper? It's not possible. So if they are reporting the
yeah,
same margins, they're reporting it incorrectly. There is no other, that is just fact.
yes, yeah,
The question then is how overflated is it? Because it may be, if it's running at it, so there's going to be some that are better than others. So some might be at a 20% margin, for instance, and maybe the owner's only doing 40 hours a week. So you're then looking at, actually, that's not a bad place to start. That's a pretty good part. But it could be the owner's doing 60, 70 hours a week. And that's why you can't really see it on paper. It's hard. It's not something you can reflect in the accounts, because it can't be shown unless somebody tells you.
yeah,
And
yeah,
that's why I'm saying to people, if they're looking to sell, just start thinking. That's why I say about the job roles and actually what's happening in terms of, because I've been involved, although in accountancy I see deals, in M&A in general, I've been involved in over 100 acquisitions in all different industries, all different size businesses, because of what we do for clients.
of
And it
course,
is the same in the accounting practice as any other business. Is ultimately what typically happens is the owner grows too quick. So the practice is growing too quick. They're getting the staff in. They don't put the processes in place. The team make mistakes. So they don't perform as manager, and they step in and fix the problems.
yeah,
Then they
yeah.
just keep bringing on, or they take the work themselves. They don't put proper job roles in place, and they don't place the right people at the right time in the right thing. And then they're too busy now, because now they're trying to manage all these people and do the work. And that's where the problems come. So, it's interesting when people go, oh, I want to protect my staff. Everybody wants to protect the staff. But in the end, if it's the overall wrong setup, the truth is the staff aren't the right staff for the job, aren't the right staff for the job. And that's just something that people have to be open-minded about.
Yeah, and have that conversation, and obviously there's ways and means of protecting that emotional turmoil as an owner of a business as well, to protect those staff. It could be as part of the conversation, if you're looking to make redundancies as part of the valuation of the business, then bringing in recruiters early doors, or maybe speaking to local businesses and asking them to go out and have conversations ahead of time, so that when the transaction does go through and redundancies are being made, or may need to be made, some of those staff may well have found another role elsewhere already, which I know takes that emotional burden off of the owners of the business, where they their guys have been loyal to them for however many years they've been with them for.
Yeah, and and I don't really say it because of the cutting costs. It's not about cutting costs. If
No, no, no.
anything, they're probably missing staff, and normally they're missing strategic staff. So they're missing like a
Hmm.
practice manager or something like that. Because it is hard. It is hard in the industry to recruit. I know I've been there. I've tried to recruit as well. It is
Yeah.
hard to recruit. So actually, what's actually happening is their cost base is understated, but they're not allocating their budgets in the right places.
Hmm.
Because they're
And
not valuing, the owners aren't valuing their own. The owners are the CEO, they are the practice manager. And if you're going to go for a commercial role of a CEO that was going to run any business, you'd be looking at probably somewhere between a 60 to £100,000 a year
hmm,
salary.
yeah.
The owners are often making good money, but I don't think many less, especially lower than 500, are paying themselves 100,000 a year. I'd say. I think that's probably related, because they're paying staff first. They're
Yes.
paying staff first, and they're not paying themselves first. So they're not really valuing their own role, because they're not seeing themselves as a CEO or an owner necessarily in terms of like a reflection point. They're just seeing themselves as dealing with these customers, because they've grown these customers over a period of time. But obviously, when a third party comes in and buys it, and they're the CEO, that role that they've got then becomes a practice manager, and that's where, what is that role worth? So that's why it's often more they're not spending enough money actually, which is why their profits are overstated, but they're allocating their budgets to the wrong places.
Yeah.
So they're not utilizing lower level resources and more cost effective solutions like AI, like outsourcing, offshoring, whatever it might be. Who's doing they're not looking at the lower level where they can get cost effective savings to then have budgets to then put them in strategic roles, so that the owner can actually reap more of the rewards. And one of the biggest areas in the end, and I know this from people that have sold, is the marketing. They are the face of the company. They are the marketing of that company. And there's
Yes.
all these little things, isn't there, that add up to what the value is of the company and how easy they can get clients without that person.
And speaking to a lot of accountants, that first step into hiring non-fee earning individuals for the infrastructure is often the hardest step, because the mentality is, if you're working for me, we need to be billing. But actually, the benefits of bringing those strategic hires in far outweighs the initial maybe hurt on cash flow and cost.
And you will drop margins. Every
Yeah,
business drops
yeah,
margin to grow. I had to drop margin because, for example, I'm implementing all of my, because obviously my main retainer clients. So my background was, I've had it 5 years, the company, but the first 2 years I actually spent I did about 15 CFO placements. I didn't have a team really. I had the odd person, but I spent 2 years just researching the market. I did 15 CFO placements, all for different size companies in acquisitions, and not because I wanted to see where I wanted to go. I then made the decision around mid 22 that I was going to go into M&A, and that was when we did our first acquisition in 23. So I basically bought all of my first retainer clients. I did have a few, but I bought them. So that's how we built our retainers up, because that's what I knew I needed. And we've been in the transition of building, because we didn't get any of these reports. But as an example, I've just spent £45,000 invested in my CRMs, data,
yeah.
technology, reporting, people to do it. So often, to actually get to the place where you can actually trade at a 35% margin without your time as the owner working 70 hours a week, because I basically work now maybe 3 days a week, I'd say,
Okay.
reality. So I've done all that and still work 3 days a week. And I'm not going to sit here and pretend I don't do anything in the business, because I don't think you can have a business for this short amount of time and not be doing anything. It's not realistic. But I'm getting to that point where I've invested the money, and I'm happy to take less money out and to have lower margins in the investment period whilst I'm building up the practice, because I see the vision of, I know where it'll be in the end, and it can be really scaled really easy, because you can get money really easily. You can get customers easy. It's whether you can make money off those customers easy, and if somebody else can make money off those customers.
Yeah, absolutely, absolutely. So, in terms of getting the seller getting prepared properly for sale, it does two things. One, hopefully, you'll see their profit margins go up, which is going to make them more attractive, which means they're maximising the value in the business. But secondly, from an acquirer looking at two separate opportunities, if there's certain things in place, they'll certainly choose you over another that's maybe not put those things in place. So that's clear. Outside, away from the business, from a seller's point of view, personally as a human being, what things should they be thinking about or considering ahead of entering the sale process? It could be having a number in their head that they want to achieve from any sale, or what their life might look like post sale as well. So yeah, from your perspective, what should people be thinking about before they look to sell personally?
Yeah, well, I mean, I have my own podcast as well, James. I mean, I've interviewed
Mm.
over 50 people on my podcast now who have exited businesses, small and big, not just in accounting, but, in general. And it is hard. It is hard to exit a business. And I think the fundamental thing is, a lot of people just think, if I don't do it, it doesn't happen. This is what owners are always saying. I think this happens in accounting and in other industries. The truth is that only happens because that's the way you've set it up. you know it's not, I don't sit here to judge anybody. I know it's hard to run a business. It is hard to have all these things in place, but in the end, it was like when I acquired my clients and we didn't bring over the owners. Well, if we can bring over 100 clients and not bring over the owners and still keep 95% of them and build a relationship and revolutionize their accounts, it's telling you it's not the owner. Because
Hmm.
actually, if it was that important that it had to be the owner, then nothing would have worked. It would have fallen over, wouldn't it? And yeah, it was hard work. So that's going to show that it's not the owner. So sometimes you only think, well, I have to do it because it's me, but that's only because that's the way they've set it up. And there is a life away from that. And so I think it has to be, it is a number, what they want from it, but the number's going to be what the business is worth. But I think it's like what they just want as their lifestyle. And that's why I do the consult for equity options, because it could just be people want to do it in stages. It might be, they don't want to. I think the truth is a lot of people are just exhausted. They're
Oh,
exhausted. They've ran these
yep.
businesses for years. They're getting older. Maybe their health's poor and they're thinking, God, I just can't do this anymore. I want out. But maybe deep down, they don't actually want fully out. They actually like what they do. They like being able to help people, but they don't know how to do anything any differently, because it's how they've already done it. So without a fresh pair of eyes, and that's why I'm not really set in stone, it has to be 100% shares, it has to be this. I just think the way it is these days with technology and stuff and the way people can partner, there's lots of different opportunities and lots of different ways to structure businesses and structure sales that can benefit everybody, and they get a better life. So I think it's more what they want their lifestyle to be. Like, what do they want? Like, do they still love what they do? Do they still want to help? And then a lot of people come to me to acquire because of all the additional services that I do, because everyone has their own skill set. We are very strategic. We're very, do a lot of consultancy, which a lot of accounting practices don't really have the resource or capacity to do unless the owner did it. And then obviously there'd be even more snowed under. So yeah, I think there's lots of different options, but I think it's just what they want their lifestyle to be. And, be honest with themselves and reflect. Are they happy with where they've built where they've built the business to? And it's fine if you're not, because you can always change it, but you've got to be honest with yourself first.
Yeah, absolutely. And that messaging is been ever more so clear in the accountancy practice industry over the last 6 months, where I think, you've got the business costs have gone up. There's additional regulatory admin now, the talent war for attraction and retention. All of that's kind of coming together, and people are just exhausted of running an accountancy practice, and they're looking to get rid of that heavy lifting of running a practice. And often at that point in time, when you ask them, what are you looking to get out of any transaction or discussions, they want to sell and exit because they've had enough. But actually, once they move into that transitional period and some of the heavy lifting's taken off them, and they've gone back to what they entered into the profession for in the first place, which was looking after clients and maybe helping some of the team and mentor the team through, they're just re-energized and they're really enjoying it again. So then a conversation may well happen with the acquirer saying, look, I'm actually really enjoying my working life again. Do you want me to hang around and stay? And then that's where the conversation comes in from the acquirer about what value can that individual still bring post transaction.
Yeah.
But no, it's really interesting, and I always say to the sellers, whenever you are getting into an acquisition or a sale discussion, is do have that financial number in mind, ballparkish of what you're looking to achieve out of it, because as you know, once you get into a transaction, there might be 3 or 4 suitors, and you start getting offers on the table, and one comes in quite high for a reason. You can kind of get blinded by the number and the offer over there. And as we know, the highest bidder is not always the best fit culturally for you, and especially with that deferred element sitting in there, you may well get a nice lump sum up front, but you're never going to see anywhere near the deferred element that you might with a lower multiple or a lower offer. But it was still, that lower offer may well have still sat in that ballpark that you was hoping to achieve in the first place. So yeah, I always say to people, go in with a good idea of the numbers, so at least you're making an informed decision when you're listening to the different offers that come on the table. But equally, have an idea on what your objectives are, both financially, but also non-financially, as you could, going back to what you want your life to look like once you transact, and what that looks like. So yeah, certainly very, 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 very important. Yeah, thank you, Julie, for your time. I think it's been really interesting. Before we do leave, I just wanted to, in conclusion, if there were 3 key points you would stress to any seller listening in right now to maximize the valuation and attractiveness to an acquirer, what would those 3 things be that they should go away and have a look at their own business on?
So the first thing is take the emotion out. Go and look at all the roles, what you want people to be doing, not what they do, what you want them to be doing, and make sure you've got those roles fulfilled. And if you haven't, just put a job, put some, some things together of what that job set could look like and what that cost would be for that role. Then go back to your accounts and see, if I put that cost in my P&L, do I make margin? That, to me, that's the starting point. thinking about, you know, what effort they now want to put into their business in terms of that multiple. You know, if they are sort of a more an older school accounting firm, you know, and they just kind of want out and they don't want to put it, then, you know, you have a think about how that could impact their valuation. And
Mhm.
also people to start looking at, you know, have they got their reports in place in their management accounts and things like that for when a buyer comes in? Because if they haven't, they're the things they can start putting in place. Obviously, they
Yeah.
need time to do that. So they've got to be able to do two things together. They've got to be able to reorganize the roles so that they have more time and then be able to implement, or they can bring people in to help them build the reports.
Yeah, I mean that data side is so important because you know in any conversation it can be such a distraction from running the business when you're in that. So if you're fully prepped beforehand, you know, not just financial reporting but all your client schedules and understanding what that breakdown looks like is very very important. No, Julie, thank you very much. Appreciate your time, and yeah, hopefully the listeners have learnt a lot in terms of getting prepared for sale.
Yeah. All right. Well, thanks for having me.
Thank you, Julie.
Thank you.